Today's tax meeting is on a couple of complexities which feed into stages 2 and 3 of the GloBE rules. Those complexities are how timing differences are dealt with under the rules and the concept of qualified refundable tax credits. Before we dive into the detail, I thought it would be useful to have a quick refresher on steps 2 and 3 of my jigsaw. So step 2 is the allocation of income and taxes to entities. And one starts by calculating the constituent entity's GloBE income. The starting point is the income for that entity in the ultimate parent entity's consolidated financial statements. To that, you need to make a series of adjustments. So you would remove dividends and gains from shareholdings where the interest in question is 10% or greater. You would also need to reverse certain deductions, bribes, material fines, and so on. Then one needs to calculate the constituent entity's covered taxes. And again, you're starting with the ultimate parent entity's financial statements and taking the tax expense from there. It's important to note that covered taxes is tax on income and profits only. So any sales taxes like VAT, any payroll taxes or social security contributions or transactional taxes, they would all need to be stripped out of that figure. And again, other adjustments are going to need to be made. For example, you would remove tax on out-of-scope income, for example, tax on dividends from shareholdings where the interest in question is 10% or greater. Step 3 is the calculation of the effective tax rate. And this is calculated on a jurisdictional basis. So one adds together the GloBE income or loss for each constituent entity in the jurisdiction that you calculated at step 2. Then you add up the covered taxes figure that you calculated at step 2 for each constituent entity in the jurisdiction. You divide the aggregate covered taxes for the jurisdiction by the net GloBE income or loss for the jurisdiction, and that gives one the effective tax rate. The minimum tax rate is 15%. So if the effective tax rate for the jurisdiction is below this, then top-up tax may be chargeable. If the effective tax rate is 15% or more, then no top-up tax will be chargeable unless there is an adjustment from an earlier year. Let's start looking at timing differences. So going right back to basics, what is a timing difference? A timing difference is a difference between tax and accounting rules as to when income or expense is recognised, and these can be either permanent or temporary. A permanent difference is never resolved. So an example here might be a fine, which is often deductible for accounting purposes, but rarely deductible for tax purposes. In contrast, the temporary difference will unwind over time. So an example would be first-year capital allowances, where for tax purposes you get the whole of the deduction in the year expenditure is incurred, versus depreciation, which is deducted over a number of years. Let's look now at deferred tax expenses or liabilities. So this is where the accounting income is higher than tax income in year 1. And this would be, for example, because of a large deduction for tax purposes than was allowed for accounting purposes. A deferred tax asset is something that can be used to shelter tax liability in future years. So an example here would be a loss that is carried forward to offset future profits. Another example might be where, for some reason, you had overpaid tax in year 1. Let's look now at how timing differences are dealt with under the GloBE rules. So the GloBE rules have a special mechanism to deal with timing difference, and that mechanism is deferred tax accounting. Deferred tax accounting is an accounting concept which seeks to match taxes to the period when the income or expenses are recognised for accounting purposes. And it does this by shifting the tax expense from the year when the tax is paid, or the tax deduction is received, to the years in which the income or expenditure is recognised in the financial statements. In the OECD model rules, what this means is that the covered taxes in the numerator are adjusted by the constituent entity's deferred tax income or expense in the period. For example, if a constituent entity pays 10 of covered taxes and recognises a deferred tax liability of 5 in a fiscal year, the 5 is added to the constituent entity's covered taxes to make the numerator 15. The numerator is then reduced by 5 when the deferred tax liability unwinds. This reduction will offset the payment of tax in that period and effectively brings forward that 5 of tax from that later year. So for a deferred tax liability, you would have an addition to covered taxes in year 1, but reductions from covered taxes in the years as it unwinds. The amount that is added in is called the total deferred tax adjustment amount. Let's look in more detail at the concept of the total deferred tax adjustment amount. And as I just said, this is the GloBE terminology for deferred tax liability or deferred tax expense. And one starts with the deferred tax expense or deferred tax asset in the accounts. To that, you need to make a series of adjustments. The first adjustment is the amount needs to be at the lower of the local tax rate or 15%. So one must recast at 15% if the local tax rate is higher than 15%. And the rationale here is that an entity in a 30% tax rate jurisdiction shouldn't get double the amount of benefit as an entity in a 15% jurisdiction from the same economic loss. You don't include any deferred tax expense or deferred tax assets associated with income that is excluded from the GloBE rules. For example, if you had a loss resulting from an excluded equity gain, you couldn't recognise that loss, and that's because income from that type of disposal wouldn't be GloBE income. Finally, you don't include any deferred tax expense increases resulting from a tax rate rise. Now, ordinarily, if a tax rate increased in year 2 or later, one would increase the amount of deferred tax expense for accounting purposes. You don't do this for GloBE rules, even if, for example, the local rate subsequently increases from, say, 10% to 15%, no change would be made. The other thing to point out is that there is a recapture rule if a deferred tax liability doesn't unwind within 5 years. Now, this is the default rule, and there is a long list of exceptions at Article 4.4.5. Those exceptions include things like capital allowances, research and development expenses, government licenses for exploiting natural resources. These are things that typically take longer than 5 years to unwind, but are as a result of substantive activity in a jurisdiction or hard to manipulate. Note that there is no requirement for a deferred tax asset to unwind or be used within 5 years, so there's no GloBE limit on the number of years that you can carry forward losses. So I thought it'd be useful to do an example on the treatment of a deferred tax expense under the GloBE rules. And we've got a company here that's buying plant and machinery for £150 and claiming a 100% first year allowance. The plant and machinery is depreciated over 10 years on a straight line basis. And there's a difference between tax and accounting rules as to when that expense is recognised. It's a temporary difference as it will unwind over 10 years. Under the GloBE rules, the deferred tax liability will be added to covered taxes in year 1, and the deferred tax expense will be deducted from covered taxes in years 2 to 10. So you will have low taxable profits in year 1 under tax rules compared to accounting, but then the taxable profit is higher than the accounting profit in subsequent years. So this is the effect of when the expense is recognised and deducted under tax versus accounting rules. And if you didn't have this smoothing mechanism to reflect the timing differences, then you would have top-up tax payable in year one, as the effect of the first year allowance is to bring the effective tax rate below 15%, despite this jurisdiction having a high headline tax rate of 25%. But with the timing difference being taken into account, that means that you still have an effective tax rate of 18% in year one. So that means that there won't be any top-up tax payable. I wanted now to talk about Article 4.1.5, and this is one of the most difficult but most controversial parts of BEPS GloBE rules, because in some circumstances it results in top-up tax being payable despite the entity or the entities in the jurisdiction being loss-making. And it applies where there's no net GloBE income because the jurisdiction is loss-making, and where the adjusted covered taxes are less than zero and lower than the expected adjusted covered taxes amount. And the expected adjusted covered taxes amount is GloBE income times 15%. So why would you have a difference? Well, the commentary says there needs to be a permanent difference between tax and accounting rules. For example, if a particular type of capital gain was exempt under tax rules but not under accounting rules, you would have lower taxes than expected under GloBE. Likewise, if there was a larger deduction under tax rules, for example, there was a super deduction or a deduction greater than economic cost, this would be a permanent difference that would result in lower taxes than would be expected under GloBE. Where this occurs, there is top-up tax, and that top-up tax is the difference between the adjusted covered taxes and the expected adjusted covered taxes amount, and that top-up tax is payable despite the jurisdiction being loss-making. Moving on now to talk about qualified refundable tax credits, and these are tax credits that become refundable within 4 years. They need to be paid in cash or cash equivalents, and any excess that is not set against taxes must be payable to the taxpayer in cash. If it can only ever be set against taxes, or the design means that the credit will never exceed the tax liability, then it is not a qualified refundable tax credit. A refundable tax credit that is either not refundable within 4 years or not paid in cash or cash equivalents is a non-qualified refundable tax credit, and that doesn't give you as good a result under the GloBE rules. So why are qualified refundable tax credits desirable? It's because they are treated as GloBE income rather than a reduction to covered taxes. And this results in a higher effective tax rate than a tax deduction. I'm going to demonstrate that in an example on the next slide. And basically, I think this may be the only route left for jurisdictions to take in order to provide tax incentives in the post-Pillar 2 world. This example is to demonstrate why, for GloBE reasons, it is better to receive tax incentives in the form of tax credits, provided they qualify as qualified refundable tax credits, than tax deductions. So here we've got a company that is spending £100,000 on R&D, and the company also has £500,000 of other expenditure. So option 1 for a tax incentive would be R&D tax relief in the form of a 150% super deduction. And although the company in this example is paying corporate income tax at 16%, because the R&D deduction for GloBE purposes is restricted to the actual £100,000 expenditure, income for GloBE purposes is £400,000, not £350,000. And what this means is that the effective tax rate is 14%. So because this is below the 15% minimum, top-up tax will be payable. Option 2 for a tax incentive would be an R&D tax credit. And I've modelled this example on the way that the UK rules work. So this works by adding the value of the tax credit to taxable income of 400,000. This gives you 412,000, and then you calculate tax on that 412,000, but deduct that figure from the tax payable. So you deduct the tax credit from the tax that's actually payable. So for GloBE purposes, you add to the income, but provided it is a qualified refundable tax credit, you don't deduct the tax credit from the covered taxes. So you would take the £64,000 figure from the example, not the actual tax paid of £53,920. And what this means is that although less tax is payable by the company under option 1, the effective tax rate is actually 15.5% and no top-up tax is payable. So to wrap up, I thought I might have a think about what the impact might be on the UK tax system. So looking first at which tax incentives might be vulnerable in the post-BEPS Pillar 2 world. I think the first thing to note is that mere timing differences are okay if they reverse within 5 years or if they are one of a list of exceptions. If not, then the tax incentive needs to be a qualified refundable tax credit. So something like the patent box is definitely not going to be okay, and that's because it reduces the tax rate down to 10%. What about research and development expenditure credits? Well, it's actually debatable whether these would meet the strict definition of qualified refundable tax credits, and in particular the requirement to be paid in cash or cash equivalents. And that's because they're linked to the company's PAYE and NICS liability. So will the government choose to convert some existing tax incentives into qualified refundable tax credits? Well, unfortunately, there's some issues with that. Whilst it might work under BEPS Pillar 2, there is a risk of fraud, and that's because any payment of cash is inherently more susceptible to fraud. Given that companies might be very quickly wound up after the cash payment is made. Then one needs to consider the optics of this, because it doesn't look very good for the government to be handing out cash payments to large companies. There's the complexity and cost of a change of law. And finally, there is a suggestion in the blueprint to the BEPS Pillar 2 report that there might be a review of qualified refundable tax credits after the first few years that the rules have been in force, to consider whether they were being used to subvert the GloBE effective tax rate rules. So not very appealing. It'll be very interesting to see how the UK government reacts to this. And that is the end of today's tax meeting.